Happy Friday, May 15th, already the middle of the month. Boy, does time fly. Markets this morning, as we can see, it's a little bit of risk off. Kospi down 6.12%, Nikkei down 2%, Hang Seng and those China-related indices, tech, down roughly about 2%. BS, NQ, RTY all down about 70, 80 basis points or so. So a bit of risk off there with crude oil also trading higher. Copper, gold, silver, all of those are trading lower. Silver was down quite a bit, I think almost down 7% at one point. Copper down 3%. Dollar pretty strong this morning. Antipodians, Aussie, New Zealand, both the weakest. So clear risk off complexion everywhere. Stock market performance last night in the U.S. session was basically all semis. Nvidia, nice pop higher, leaning on some positivity coming out of China. The chatter around Nvidia being able to sell their chips to China coming back, which means they'll expand their revenue base, etc. So nice big lift there. It's done a lot to help the broader indices, but there's a sense that we could be seeing a blow off top here, in my opinion. Be talking about the consumer, the retail sales report, very, very strong report in brackets for now, because, correlations are coming back, meaning that, the macro might start to matter again. I think you just can't go on for too long with ignoring the macro developments. And it gets joked about, but this is a framework that served me very, very well, and how one can sort of prepare for any changes in market conditions. Usually very, very reliable. Is this the top? As I wrote about in the last weekend note, that the signals are mounting, that we could see one. Even Michael Burry talked about this being the scene right before bloody car crash. Are we seeing some of that now, today, this morning, and even last night? Despite Nvidia's pop, there were signs in other markets, in rates, in dollar, in metals. So putting it all together, thinking about the bigger picture rug pull type of setup after a pedal to the metal rally of metals as well as risk assets, there are signs that it's stalling, it's reversing. Technicals look very, very strong and quite convincing now, rather than just some sort of little bit of exhaustion type of structure or whatever. It really does look like we could be on a trend turn here. For the short term, the question would be whether to chase or fade the moves. I think you could argue both ways because we are back to some very important levels. And we've sold off quite a bit, corrected quite a bit. And when you have big technical levels, there's usually a trade there, right? Because you're going to expect some sort of reaction, whether it's from shorts taking a profit or longs trying to attempt to look for some entries. But I think it's important to understand that this is now a counter trend move in terms of buying risk, buying metals or selling dollars. In my opinion, I think we're starting to trend. So I wouldn't stick around for too long, but I do think there could be some nice trades in there. So counter trend, yes, but bigger picture, I think should keep that in the back of mind and look at chasing the bigger picture, although there could be some short-term quick fades in the moves that we've been seeing. Looking at the data, we've seen a little bit of a downshift from the March numbers, but we did also see a big spike in gasoline during the March month, and the 3-month trend, it's actually quite strong. And when you're looking at the X autos and gas, taking out the autos because they're big ticket items could lead to some very up and down type of readings in retail sales. And then you take out the volatile gas component. The orange bars shows that consumer spending has actually been quite good. A little bit of slowing in the monthly, but the overall trend is quite good. So spending has been quite strong and quite impressive when you think about tariffs having an impact over the last sort of 12 months or so since last April, Liberation Day and all that stuff. It's been very, very good. And then we have gasoline prices surging, and then we also had crude oil prices surging around this sort of period too, right? We were in the 60s not so long ago, and now we're in the hundreds. So considering that surge and change in the tariff backdrop, consumer spending being fairly resilient, but can the consumer keep this up would be the big question. And I would seriously doubt that because there is a stagflationary risk clearly building, and it will eventually bite. And so it's logical enough to believe that it will dampen demand and hit spending, barring any new major fundamental developments as things currently are and things currently point to. So all in all, a great consumer report, but massive, massive risks ahead. Trump, the Xi meeting has looked like it has gone very, very well. I think the images are kind of showing how Trump and Xi has really managed to stabilize ties, right? You can see Trump there with that, handshake, taking the under on it every single time, leaning in and really kind of showing a lot of respect and really going out of his way to try to improve relations between the two. Looks very good indeed to me. So in terms of any trade relations and the trade war that we saw last year, I think we can start to put those types of risks and the fallout from that to rest, and things will gradually should improve from here. Looking at some headlines, cement stability, trade ties, all, stabilized trade relations, all looks very, very good. Even Xi apparently has told US CEOs that China will open up more. And then on other matters of trade, renews import permits, purchases of American crops, the market reacting to that, expects China to commit billions, and so on. So very, very positive stuff on the subject of trade. Apparently China is supportive on the Iran war. We'll have to see what China says. I'm not sure they'd be as to say it outright like this for themselves. U.S. says China wants more of its oil. Trump says Xi likes the idea of buying more oil from us or from the U.S. Some emphasis on Taiwan in this meeting, but I think it's a little bit more of a sideshow. If anything, will probably just remain to be a relatively contained risk, although it could be a lingering one. Trump inviting Xi to the White House in September. So it all ends. Trump boards Air Force One. Things went just about as expected in Beijing, with it being rather uneventful. I'm not sure I'd agree with that. I think it has been quite a good, productive one, as we saw in those images. And in the headlines, I think it's really done a lot to stabilize ties between the two, if not improve them. In terms of market news, we saw Kospi down quite a bit, 6% or so. EM stocks tumbled the most, Kospi being part of that EM indices. Nvidia, big day yesterday, but is at the blow off top. We shall see. Treasuries, the big one, being sold off, yield higher, inflation concerns is being blamed, and also rising Fed hiking expectations in the front end. Japanese yields also rising to record highs, clearly hitting risk assets this morning, along with precious metals and metals. Dollar finally responding as expected. It's been behaving rather strangely over the last week or two, but now is showing its correlations are coming back. The pound as well, obviously getting hit as a result of the uncertainty around the UK. Hope a lot of you have some exposure to that. DOJ expected to raise rates, but it's all well communicated and priced in, so I'm not expecting any surprises there. Interesting yen spikes last night and just got completely lapped up and back where it started within, 5-10 minutes, 15 minutes. But interesting spike there. puts traders on guard for intervention, sows some doubt for traders. Quick look at the regimes. So the candles is the December 2026 rate hike pricing, and we have drifted higher. We were looking at as much as 12.5 BPS of hikes, which means, 12 and a half of 25 is 50%, right? So roughly about a 50% odds of a hike by the end of the year, loosely speaking. The curve is still in a bear flattening regime, seeing a little bit of a steepening response to the strong consumer report last night. But generally, we're in a bear flattening regime there. So key macro signal to keep in mind, obviously good for dollar, not good for stocks, not good for EMs, not good for a lot of things, really, this regime. In terms of the 10-year model, we have gone from a expansion and buying, where, all these rates are going up, longer-term growth and inflation expectations are going up, market's feeling great again, and then it's starting to flatten out a little bit. The market is becoming less excited about growth as they were before. And then, as we can see in prior transitions, this is what usually precedes the recessionary and sort of the tightening phases, right? So you have this green, you have this blue, and then you enter, potential doubts about long-term growth because, maybe policy expectations need to be tighter and so on. And then you go into this phase, and usually, these sorts of phases aren't good for risk assets, right? So if we now switch over to the S&P, it's just following that same boom bust cycle that you see in a lot of other things. We're now shifting out of the good part. Growth expectations are beginning to slow. And at some point, these higher growth expectations will start to translate into tighter financial conditions because growth has been strong, longer-term inflation expectations have been getting stronger, and that has to be countered with some tightening. And that's when we usually go into the red sort of phases. And, when you look at the red phases, it's never really been too good for markets. So it's been great, but it's clearly starting to fizzle out a little bit as I've been starting to flag some early signs of that. Looking at the S&P, the chart structure is looking quite interesting. So this was the May period. We'll start from the April. So April is where we started the rally, going much above the year beginning levels. And then from May onwards was really quite impressive stuff. It was just taken over by semis. The breadth became narrow from that point on. And then if we look at the structure, it's looking, like price action is starting to become a little bit more compressed between these ranges. So a nice solid trend line, 3-touch trend line. If we do start to break below that, then we can see a solid break of structure. For now, it's still iffy. There's a nice little trend line here where, it's been nicely negotiated a few times, and then we're finding a bounce now. So I think that's a good trend line to keep in mind for today. If we break below, then I think the risk bias shifts negative. Stay above, I think there's some potential for recovery just on a purely technical bias and recover somewhere back towards the highs or these sorts of consolidation ranges, which is only about 23 points of room, not very, very much. So still very, very tight ranges that we're dealing with. Very tentative type of technicals, I'd say. Looking at the daily chart, we're on a course to have a full sort of bodied bearish bar that reverses yesterday's gain. And that would amount to like a 2-day reversal, right? We had a lot of buying pressure and then a lot of selling pressure to just finish the last 2 days flat. Looking at metals, now I did talk about whether this could be a fade, and I think it's decent. I think there's a decent trade here because the level here, this band, 4555, 4560, is a very, very strong level. So expect a reaction. I know, I think one of you has decided to trade this to the upside, and I think that's a decent trade. Would I expect any? Would I hang around very long? I probably wouldn't. So 4580 already is looking like a decent place to start taking a little bit off and then trying to run the rest and see what you get, and then look for the downside trade, because I think the trend is quite there. There is a trend emerging now, right? You look at these candles, it's starting to get bigger to the bear side. The weekly candle completely reversed and now leaning heavy against this whole 4500 to 600 area again. DXY also on a nice breakout, clean. There is a little bit of resistance up nearby, even at these sorts of levels. So there could be another reason why to think there could be a fade trade here. But I think there is a trend emerging, bigger picture. So that's how I would put that. Other things. Looked at silver. Silver, same as gold. I think it's hit some big levels here again. I think it's potentially fadeable, but I wouldn't look for a ton of upside. Think about the big picture, which is this sort of huge sell-off here, and momentum clearly shifting to the downside. So I'd like to stay short. You know what? If we do get to the 80s again, 81, I would consider adding back some shorts. Maybe 82, confluent with this 38.2 and this 38.2 retracement. So 82, 82s. Should we get there, I definitely think about adding back some risk there on silver. Pound, looking quite good. I think I think this is now on its way to 1.3250 type of levels, which would take us back to these type of lows, basically reversing the whole April-May rally, 3260. In Euro Pound, I think we could have a couple bounces along the way, but I think the bigger picture objective is going to be there. Euro Pound also reaching there's a lot of resistance above here. Lots of wicks, downward pointing wicks from this region, and we got another one. So maybe a little bit more consolidation before its eventual move towards these sorts of highs, towards 0.88. I think, I think it will eventually point in that direction. Obviously, it depends on UK politics, but does look quite uncertain as things are. And probably even more uncertain if Andy Burnham comes into the fold, I would think. So your pound, the pound trades, the metals trades, we covered risk, we covered dollar, and yeah, I don't think there's much else more to cover. U.S. 10-year yields, look at that, huge continuation move. It's a little bit of a bloodbath in treasuries right now. So clearly a risk, clearly don't want to be, this is telling you that you don't really want to be too complacent in fading anything, without that really collapsing back to below the type of levels that we saw and settled at in recent days. Before that, there's no real reason, this isn't, it's basically telling you that the fade trades probably won't hold up. So we'll probably need a trigger, a data to change this kind of narrative and this tightening narrative in the front end. So with that, I think we can wrap it up there. And yeah, we'll see if this is a blow off top in equities, which I think there's a reasonable chance of it being one. We closed at 7501. We're set to open a fair bit lower, completely reversing yesterday's gains. So if today's close is as weak as it is at current levels, then I think the trend turn is on. So let's see how we go, and we'll speak to you all in the chat. Cheers.